In the following video, we're going to take a look at subsidies, how they impact the market, and their incidence. We will need to establish a basic understanding of subsidies first and move forward from there. Subsidies are a benefit given by the government to producers to reduce their cost of production in order to encourage further production. They may also be given to consumers to encourage the consumption of merit goods, such as higher education. Subsidies could be provided to companies that develop clean energy to encourage research and production. And subsidies can also increase employment by reducing business costs. We'll take a look at the impact of a subsidy for products that have elastic demand. With this market in equilibrium, we establish our starting point for analysis. Suppose the government introduces a subsidy, decreasing the cost of production for firms. As they are providing a per unit subsidy, the new supply curve is parallel to the initial supply curve. After the subsidy has been given, we can see the supply curve shifts rightward. The new lower market price is PC, and the new higher market quantity is Q1. Therefore, the impact of a per unit subsidy on a product with elastic demand is to reduce equilibrium price and increase output. However, it is important to note that the impact on price and quantity largely depends on the elasticity of demand and supply. The distance between the two supply curves is the value of our subsidy, as indicated by the green arrows. While subsidies can be targeted at certain industries, it is important to remember that they have an opportunity cost. Subsidies come from government revenue, which is collected from taxpayers. There may be some inefficient spending that arises, and there is also the potential for government failure. If you haven't yet mastered the incidence of tax, go back and review that before going further into the incidence of subsidies. This is a bit more difficult to grasp. The price now paid by consumers in this market is PC. They have not benefited from the full value of the subsidy. Some of the benefit has been absorbed by the producer. The price paid by buyers, or by consumers, is PC. But the price received by sellers is PS. When examining who received the benefit of the subsidy, it is clearly shared between the producer and consumer. The consumer's benefit is shown in green, whereas the producer's benefit is shown in red. In this case, we are examining a producer subsidy, which shifts the supply curve. The government may also provide consumer subsidies, which would shift the demand curve. Try changing this graph with various elasticities of supply and demand. You should really try hard to get comfortable with the ranges of elasticities in order to consider yourself proficient with this topic. Alright, I hope you're still with me and are feeling more comfortable with the concept of subsidies, their impact, and incidence. This stuff is not easy, so make sure you go back and review it. More importantly, try some graphs on your own. You really can't master this unless you practice, so get practicing. As always, feel free to contact me at EnhanceTuition@gmail.com or tweet me at EnhanceTuition. Leave a comment below if there's anything in particular I can help you with.